Hi everyone and welcome back. Today I will be reviewing 4 ETFs, VGRO, XGRO, VBAL, and XBAL, and which account they should be held in. To avoid repeating myself from a previous video, please check out my video called S&P 500 ETFs for Canadians to see why you should consider which account your stock or ETF is purchased in and how taxes might affect you. Before I get started, please thumbs up the video and subscribe to the channel. Also, leave a comment on any other topic you'd like covered. Remember to turn on the notification bell so you get a little ring every time I release a video, usually once a week. Why would someone be interested in these ETFs? Stealing a quote from Warren Buffett, a low-cost index fund or ETF is the most sensible investment for the majority of investors. That's where these 4 ETFs fit in. They're not exactly index funds, but they're a great starting point for any portfolio. VGRO is a low-risk ETF and an easy pick for beginner investors. It's pretty diversified and the management fee isn't too bad. It's a lot easier than picking your own stocks, especially if you don't have the expertise or knowledge to do so. And it might actually perform better than you picking your own stocks. It's heavily weighted in the North American market, with around 40% in the US and approximately 30% in Canada. XGRO, instead of being listed by Vanguard, it's being listed by BlackRock. It is super similar to VGRO. It's hard to tell the difference, but it has slightly more exposure to the US market and a slightly lower management fee. But what are the differences between the two? Let's look at the details and break down some of the differences. VGRO has a 0.25% management expense ratio, whereas XGRO has 0.2%. This makes XGRO mildly better in terms of expense ratio. However, the tables turn when you look at liquidity. Average volume of 220,000 for VGRO and 82,000 for XGRO. I mean, this isn't the biggest deal breaker, but the chances that you can sell ASAP and maybe even get the price you ask for would be higher with VGRO. If you own one, ideally you wouldn't purchase the other. There's too much overlap. You're pretty much buying the same thing twice, unless you're okay with that. Even if we take a look at the charts for the past, let's say 3 months or 6 months, the movements are also identical. So do your research on each one. Do you want lower management fee? Do you want lower US exposure? Do you want more liquidity? Pick one and hold for the long term. You'll be good either way. These two are very hard to tell apart, but if I were to choose one, if anyone cares about my opinion, I would go XGRO, mainly because of the slightly lower management fee and the slightly better performance in the past. If we look at the past 6 months, VGRO has gone down 4.9%, whereas XGRO has gone down 4.74%. Again, it's not much, but if I had to choose, I would go XGRO. If you were to purchase one of these, you have a decision to make. Which account do you purchase it in? To keep it simple, let's just choose 3. Let's go taxable account, TFSA, and RRSP. Because these are Canadian listed ETFs with US holdings, there will be foreign withholding tax. No matter how you slice it, there's no way around it. There will be a slight drag on your returns from foreign withholding tax. If you take a look at the yields on these 2 ETFs, they're around 2.4%, but not all are US dividends. Some are Canadian ones, making the foreign tax hit pretty low. I would recommend purchasing one of these in an RRSP or a TFSA. What you'd want sheltered is your capital gains from holding over the long term. I think it would be much higher than only the US portion of the dividends that you'd have sheltered. Moving on to VBAL and XBAL. These are very similar to the 2 previous ones I just mentioned, but they are considered a little safer. They're more heavily weighted in fixed income. If we take a look at the holdings, where XBAL holds 60% in stocks and 40% in bonds, this is the fixed income, XGRO holds 80% in stocks and 20% in bonds, leaving you more exposed to the market fluctuations and market downturns. VBAL and XBAL are recommended for the more risk-averse investors, and again, I would recommend holding these in a TFSA or RRSP. So let's say you decide to invest in ETFs, should you invest in both XBAL and XGRO? I'm not so sure. Let's look at the largest holdings of each one. They're the exact same, just in lower percentages. If you decide to purchase all 4 stocks in this video, or even just XGRO and XBAL, it appears there's too much overlap. You're buying the same thing twice with a slight variation in your bond exposure over the long term. That being said, which one would I choose, XBAL or VBAL? Again, if I had to choose, they're both very similar. I would go XBAL due to the lower expense ratio that would affect your returns over the long term. Now let's take this even further. Out of all the 4 I mentioned, which one would I choose? I would purchase XGRO in my TFSA or RRSP. Alright guys, short video today. Please leave a comment on any other topic you'd like covered and hopefully I can get to it. Check out my past 2 videos where I reveal my entire portfolio as well as the dividend income I get from 1 month from this portfolio. Check out my upcoming video where I break down which 2 dividend growth stocks to buy and hold forever.